please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Let's get an important market voice now. Neem Kumar, the head of institutional equities of IIFL, joins in from the sidelines of their IIFL conference that is underway in London. Neem Kumar, good morning and thanks for joining us. First, I want to start by asking you the mood. What is the mood among FPIs with regards to investment in Indian equities? They have mostly been sellers so far this year. Do you think that trend would continue?
I think foreigners in general, they have been very surprised by the big strength in Indian markets, and that the valuations have expanded in the face of the turmoil in emerging markets, and as well as the weakness in rupee. I think this is the first time where we are seeing rupee at a new low and markets at a new high. So it's actually in a way kind of surprised people, but all I would say is that a lot of emerging market investors are also getting hurt with their overweight position on China, and most investors have a kind of neutralish, some were underweight of course as well. So the overweight position in China is hurting them a lot. But I think in India there is a general now consensus that growth is now coming back. Earnings growth momentum in the next few years is likely to remain strong, and valuations have been rich in India. If you want to buy, India has traditionally for foreigners been a bottom-up stock market, and buying good quality stocks means that you have to pay up to own them, because over the longer term it has panned out well. So the value investors are really struggling, because for them justifying valuations at current levels is a challenge. But the lot of Indophiles, guys who investors who like good bottom up structural growth stories, they are happy to stay put.
Okay, what about this trend of reversal of FII outflows? I mean, we've seen that being very, very sort of steady so far this year. Is that likely to reverse anytime soon?
I think in the short term, one should not expect flows to come back, given the worries centering around emerging markets. I think some of the global guys, of course, get enthused about one stock here or there. But I don't think that the flows from FIIs is going to turn on the positive side, or on the negative side as well. It will be just some marginal pluses and minuses is what I think will happen. We'll have to once this year passes, I think we'll be staring at the elections, and starting early next year, the initial forecast in terms of what the poll outcomes could be the driver. But in the near term, I don't see any big uptick or downtick in terms of flows as such. Some bit of selling is not too big. I mean, this kind of selling can be easily be absorbed by the market.
Okay, so the selling can be absorbed by the market, but is the mood very different amongst domestic funds now? Are we expecting continued domestic inflows into equities through the course of 2018?
The flows in the domestic mutual funds, my belief is that they will remain robust. We have seen some bit of softening in July. I have not yet seen the month numbers for August. But my belief is that flows into domestic mutual funds will remain robust. There are a lot of flows that are coming into AIFs as well. So I think that will be the mainstay for the market. Within the domestic funds, what we are seeing is that there are some fund managers who are cautious, again, given the big valuation expansion that has happened. But every fund manager has a different style, right? So as long as money is coming in, it finds its ways either into the primary or the secondary market. So I again think that the domestic flows will be supportive of the market, as it has been in the recent past.
Okay. Well, just some thoughts on the macros. Now, we've seen this 8.2% GDP growth number. That was fairly robust. So how do you react to that?
And what is your expectation from corporate earnings?
One thing is for sure that consumption momentum is really, really strong. Consumption momentum is strong because of a variety of reasons. I think one is GST rates have been brought down. Secondly, your financing is now much more easily available because you now have credit history. The third thing is that competitive environment is driving down prices, innovation is driving down prices, which is driving up affordability. So despite all the concerns on, lack of enough job creation, etc., or even farm stress, what we are seeing is that there are other drivers for consumption growth. So you look across FMCG, you look across consumer durables, we are seeing a sustained growth pickup that's happening. I think in this cycle at this stage, my belief is that consumption will continue to drive GDP growth, investment cycle is still weak. It may take some time, maybe after the elections when we have better clarity on the new government, you will see the cycle slowly turning.
Okay, so the investment cycle is not picked up just yet. But is the rupee depreciation and rising oil prices keeping flows away, you think? Where do you see the rupee and Brent heading? And what's your take on the twin deficits and the impact that it would eventually have on, the equity markets?
Very hard to forecast oil prices, so I wouldn't venture into that. But assuming that the current oil prices are there, will be almost, just marginally short of the FY13 peaks in terms of the current account deficit that we had, because there are several other items where we have seen an acceleration in imports. The exports is very difficult to forecast at this point in time, but I take a lot of comfort from the fact that typically, with this extent of rupee depreciation, exports growth should see an acceleration. So this is a natural mechanism for rebalancing the current account, and therefore I think at some stage you would actually see exports growth also pick up. But at this point in time, if FY19 current account deficit, will be very close to the peak that we had in FY13-14, and hopefully we'll see exports revival in FY20. And already we have seen some green shoots there, but we need to see a bigger acceleration for trade deficit to come down. My hope is that oil prices don't significantly go up from here, and if that be the case, I think that assuming that exports revive, then probably things should be okay. Now again, forecasting rupee is as hard as forecasting oil prices as well, but my guess is that a large part of the depreciation or readjustment that need to happen has already happened.